everyone! Today, let's talk about gold. If you melted down all the gold humanity has ever mined and poured it onto a standard football field, all you'd see is a golden slab about 1.5 meters high.
Wow.
Put another way, that gold probably isn't even enough to give every person on Earth a single band. You see, this thing doesn't generate cash flow. Unlike stocks, it doesn't pay dividends. Unlike property, you can't live in it. It doesn't even improve productivity. So why is it so popular? Today, from an investment and financial perspective, let's break down gold and make sense of why it matters. If that golden slab you just saw is the total stock of gold, the next question is, how much does it actually grow on this planet each year? All the mines in the world, working flat out for an entire year, only make that slab a little fatter by about 1 to 2%. Think of it this way, you can build housing in massive blocks pretty quickly, but gold is the kind of thing you just can't rush. No matter how hard you push, a large gold mine can easily take 8 to 10 years to move from exploration and permits to roads, infrastructure, and actual production, which means even if the gold price suddenly spikes, mines can't just dig twice as much overnight to match market sentiment. A core reality in the gold market is this: supply is very stable. What really swings around is the other side, human demand and emotion. So gold's scarcity isn't about suddenly running out. It's about how slowly new supply trickles in. Most of the time, price swings are really just a reflection of human psychology. That implies one thing: gold's price is driven far less by production and far more by people buying it. Demand for gold mainly comes from 4 sources. First, jewelry. You might think most gold today is bought for investment, but in reality, nearly half of each year ends up as jewelry. China and India together consume more than 60% of the world's jewelry gold, and India holds the most private physical gold. Its beauty, how it looks, is a big reason gold has held value across thousands of years. Second, central banks, a key force many people overlook. On average, about 1/6 of global central bank reserves is in gold, and in recent years their gold buying has hit record highs. There's really one main reason: long-term worries about fiat currencies. As debt piles up and money keeps expanding, gold becomes the ultimate backing of trust. Third, private investment, bars, coins, ETFs, and futures. You might think paper gold dominates, but in reality, more than 2/3 of private gold investment is still in physical form, because it has one advantage financial assets can't offer: when it's in your hand, your mind feels safer. Fourth, industrial and other uses, electronics, medical, precision manufacturing. It's a small share, but a steady one. Over the long run, gold has indeed done 2 things. First, it has hedged against monetary inflation, not in the short term, but over spans of 10 years or more. Over the past half-century, gold prices have roughly kept pace with global price levels. Second, it tends to move opposite to risk assets. When stocks fall, gold often rises. But here's a very important however. If you stretch the time horizon, gold looks like a stabilizer, but when you zoom in, you'll see its price can be wildly volatile. Over the past 50 years, gold's annualized volatility has been close to 20%, even higher than US equities. There have been stretches where it fell for nearly 20 years straight, and others where it shot up several times in just a short period. Why? Because 2 unquantifiable forces are baked into gold's price. First, our emotional attachment to gold, not rational, but trust etched into human civilization. Second, speculation. When prices rise, hordes of retail investors jump in, chase the rally, panic on drops, and amplify volatility. Those 2 forces make gold an asset that works over the long term, but is very hard to predict in the short term. In this latest rally, there's something unusual. The US dollar and gold are rising together. By traditional logic, that almost shouldn't happen. On the surface, there are plenty of reasons: inflation, geopolitical tensions, expectations of rate cuts, central bank buying. But the core is this: the rally itself has activated gold's 2 most dangerous forces: emotion and speculation. Once everyone agrees gold is going up, just talking about it becomes free advertising. More people pile in, push prices higher, and attract even more buyers. That's a classic positive feedback loop. The conclusion is simple: gold is not a short-term trading tool. It's not a high-return asset, but it is an excellent risk hedging tool. Professional institutions rarely go all in on gold. Even when they allocate to it, it's usually no more than about 5%. For regular investors, gold's real value comes down to one thing. When you have no clear answer about the future, it gives you a psychological anchor. But remember, gold is there to ease uncertainty, not to make you rich overnight.